You've all heard of credit. Credit is the ability to borrow money and pay it back later. But a lot of what you hear about credit goes something like this.
Credit can either become a tool or it can become a trap. If you don't have credit, you don't have a credit history, and if you don't have a credit history, you don't get credit. So you're almost like in this Chakravyuh, and that is a feature of our banking system.
Sashank and Gaurav at Axio thought they
It needed a new approach, and that new approach in our mind was tech.
That makes sense. But what does Axio do?
You ideally should be able to have your credit provider be wherever you are. Our goal is to be seamlessly integrated into your favorite points of shopping.
That's what we call checkout finance, to purchase online with easy installments. The second product is typically offer larger loans.
The third product we offer is personal finance management for customers to be more conscious of their money. And by doing so, the idea is to create these credit histories.
Okay, great. But why should we have a credit history at all?
I genuinely believe in the power of credit to grow productivity. I genuinely think it's a GDP multiplier. And I think we're doing it really well. So
On the fourth or the fifth month, I just ghost you. How does that work?
So let's take an individual, let's call her Sheila. She runs a small local pharmacy. Sheila is someone who will have a bank account, someone who is financially quite healthy and quite prudent. But chances are she will not get access to unsecured credit. Let's say her son needs to buy a camera. Now, why should Sheila put up her house to get a camera? That
Right.
makes no sense, right?
Right.
So this is where we come in. If she can actually buy that over 6 months at no cost to her, she gets to buy the product, she smooths out her cash flows, we get a customer, the merchant makes a sale. It's a win-win. It works for everyone. She is now starting to build a credit history with us. Ultimately, credit works best when you have a corresponding income stream. Individuals who tend to be self-employed, who live outside of some of the larger cities, are all banked but would struggle to get a loan without collateral. But if you don't have credit, you don't have a credit history, and if you don't have a credit history, you don't get credit. So you're almost like in this Chakravyuh. That's where we try to come in.
So tell us about the journey, your story. How did you find this opportunity? Everything.
Shashank and I actually met at business school at Stanford. We were both passionate about coming back to India, starting something in technology. And so we took the leap in late 2013, early 2014 and started this business. And so I think first year was all about kind of just convincing people. Year 2, 3, we started to get the business going. We actually started giving loans. Year 4, year 5, we really hit a peak. We were amongst the first few and largest digital lenders in the country. Made several changes in the business, one of them being the move from Capital Flow to Axio as well. From then on, it's been a very interesting upward journey as well over the last 3-4 years, where today we are serving almost 9 million customers.
Can you get into what product offering you offer to your customers?
We are present at the point of checkout. That's what we call checkout finance, basically allowing customers to purchase online with easy installments. The second product is for, again, customers who have been with us for 6 months or 12 months. So
Right.
there we typically offer larger loans and it's a longer tenure.
The third product we offer is personal finance management
Okay.
through our app. And there's a very important reason why this is in a credit business. We also want to offer the right toolkit for customers to be more conscious of their money. And by doing so, the idea is to create these credit histories for all of these individuals who, for whatever reason, today are overlooked by the banking system.
Did you start with a VC funding or was it you family investments? What did it look like?
Obviously, it's a lending business, so money is the raw material. So we needed money to lend money. We didn't have that, which is when we actually went out to equity investors, to VCs, etc., and said, hey, this is an idea. We are going to disrupt lending. We are going to make it much faster, easier for people to take a loan. Why don't you kind of take a bet on us and give us, I think we were trying to raise $1 or $2 million at that point in time, right?
We raised about $150 million till 2021. We raised $50 million raised from Lightdraw,
And what is the total net worth of Axio?
about 360 crores.
So I see that you've built a technology first brand, but you both come from a business school.
It needed a new approach. And that new approach in our mind was tech. We have really been a tech-first company. We actually hired a really strong CTO. We ended up building everything from scratch. And initially, this felt like a lot of work. It actually turns out that our tech stack was the only one agile enough to match the level of speed that e-commerce requires. All the different parts, building blocks of a lending business, we built ourselves.
Right. And if not by yourselves, who are you working with?
So we do everything in-house. We're
Okay.
very much a build, not buy company. Credit risk in general is a lot about monitoring. If I am extending credit to you, right, I'm expecting that you will be a responsible customer and give it back. Say you came in for a loan. If I make a decision on whether or not I lend to you just based on your bureau, I'm no better than any other lender. My estimation of how much you can afford needs to be really good. Is it accurate or not? is really important, which is why monitoring is like super critical. The differentiation gets built when you take that data and say, hey, like what intelligence can I build on top of this data? I've also run an income predictor, which we have on top of Bureau. I now have a layer of intelligence that is better than other lenders out there.
I would have some safety concerns and data privacy issues in mind.
Yeah.
So how do you as a company tackle that?
It's important to us that the customer knows that the loan comes with certain obligations, right? Taking consent upfront for pulling a customer's bureau
Right.
or their KYC. Showing them all the terms and conditions of the loan. Continuously sending them documentation. We actually created, with a bunch of other players, an association. It's called the Digital Lenders Association of India. As part of that, we actually created a code of conduct. So this is the beginnings of what we call self-regulation.
All this data, what we are able to fetch, resides in data vaults. Even we can't access that data. At no point PII data, which is personally identifiable information, is shared. A lot of data has to be purged. Like we don't save Aadhaar numbers and so on, which can be later be misused. So we have to purge those numbers. And of course, the entire stack is on cloud, on AWS, where we have the highest level of data security possible.
So how are you guys actually making money on top of that?
The interest is how we actually earn money, right? Then the second product, like I said, is a personal loan. There, the interest is paid for by the customer monthly. So our main source of income is interest. And in certain cases, we ask for processing fees also.
So is this commission enough to sustain this kind of a business? And are you guys profitable?
So you take the example of, let's say, a Xiaomi phone. They have enough margin on their product that they will pay for the interest.
So why can't Xiaomi do that by themselves?
See, I think every business and organization has their expertise, right? Theoretically, they could do it themselves. But we've now, over years, developed the ability to decide whether you deserve a loan, she deserves a loan, maybe he doesn't deserve a loan. That ability, for example, is in the DNA of the organization, right? Xiaomi could do it, but it may take them many months, many years to actually perfect that. The second thing is, in India, you need to be a regulated entity to also lend. But the focus is, like I said, for people to do businesses that they are their core bread and butter. For the last year or so, last few months, we've been profitable. But as you scale, this is a very well kind of established business model. And we're not the first ones to do it. People have done this before us and done it very, very successfully. I think what we bring to the table is a bit more customer focused, UI, UX, more technology, be able to do it much faster, better, right? If you provide credit to these customers while they are making the purchase online, our history tells us that sales can improve, the average order value can improve, the drop-offs at checkout reduce drastically, right? So we are able to pitch an offering that actually is working with them, right?
There is enough traffic that comes in. The goal is not to get everybody in that traffic to know about us. The goal is to ensure that somebody is direct to the cart and gone to the payment, and then they decide, should I drop off now? Can I help him stay back? Can I help her stay back and make it more affordable for them?
Right.
That is where we come.
So what does that tell us about your revenue model? Is it even sustainable and viable?
Why don't we sit down and talk numbers? So our revenue's been growing quite rapidly, right? We've been doubling or tripling for the last few years. 7 million loans a month. What that adds up to is about 8,000 crores of lending a year. We do over 750 crores a month total.
Not being at such an evaluation, how are you actually lending such big amounts?
So we do this in two wings. One is we are an NBFC. NBFC is a non-banking finance company. It's a specific regulation from the RBI that allows you to lend but not take deposits. As a regulated entity, we have a balance sheet. What we've built over the last few years is a very interesting model around co-lending with banks and other large financial institutions to be able to leverage their balance sheet strength to funnel credit to these customers. But this allows us to actually scale well beyond the constraints of our own balance sheet and meet the kind of demand that you asked me about.
Essentially, we figure out a way how to borrow from larger banks and get it to the customer. Obviously, we borrow at a certain cost and lend it at a higher cost. And the spread in the middle is basically our revenue.
This is at the end of the day a credit business. So the most important metric is NPA. NPA means non-performing asset. NPA is basically how many of your loans never come back. And that number for us today is under 2%. Through this period of doubling and tripling, our NPAs have remained the same, under 2%.
I just ghost you, I am not paying my payments. Then how does that work?
There will always be a certain percentage of people where that happens.
Right.
Right? Because let's say you may have genuine reasons. As long as the numbers in around the 2% range, you're fine.
So what do the unit economics look like?
Let's say you charge, let's say 100 rupee loan. Rough interest is 20%. We borrow at, let's say 10%. Balance spread is 10%. Now, in that 10%, we have to account for 2-3% NPA. We have to account for our OPEX. We have to account for the cost it takes to onboard a customer. All of that has to happen within that 10%.
Being able to run our models that fast and decision people in milliseconds takes a lot of like computing cost, right? So
Right.
computing cost is a large one. And then obviously the cost of our teams, which is I think more than made up for with the NPA number that you mentioned. And then of course like the cost of collections. It's like 9 million customers. Servicing all of those customers and collecting back from them is obviously a cost of running business.
It's a lot more on content creation that we spend,
Yeah.
but it would not even be barely 5% of what we make.
And what do your customer acquisition costs look like?
Zero in my opinion.
For us, when we say our CAC is zero, essentially what we extend is a checkout financing product. That brand needs our product for them to sell more. So we don't extend any CAC there. So our margins are very thin in that product. And then we try to do repeat transactions. What we in return get is a repayment track record. Once we establish this fact, we are able to extend larger credit products like personal loans and so on. In this entire cycle, we are able to save CAC.
If we see Axio's competitive landscape, if I open Zomato, they're simple, or any random shopping website as well.
Yeah,
Yeah.
and by design. And you'll never see large ads from us. So actually it allows us to be very lean and quite profitable. And that's the benefit of this approach. Everyone who is a customer knows Axio once they discover us. And that's more than good enough.
If we go back to 2013 when you started out, we had Paytm, PhonePe and MobiKwik. Now that they're unicorns, Axio is still under that, even though it is such an old company now.
So a lot of the companies you mentioned have been payment companies. And I think they've done an awesome job in laying payment rails, because unless people can have digital payments, it's very hard for them to access other digital financial products. And the next layer is credit. Because once you can transact digitally, the next thing you want to do is also be able to borrow digitally as well. Are we now like on the cusp of, I think, really, really big growth, not just for ourselves, but as a sector? Absolutely. In India, like you're always going between peacetime and wartime because it's such a dynamic country.
Right.
Can you provide us with an instance where war and peacetime happened with Axio?
COVID, all our borrowers were real people or real business. And over COVID, everything shut overnight. And suddenly you had a situation where people couldn't pay back. The government stepped in and tried to provide relief in the form of a moratorium. Suddenly, you have millions of borrowers all over the country, different moratoriums, and we had to change our systems overnight to be able to accommodate this need. Remember our tech team literally pulling like all-nighters. In retrospect, actually, I think quite a good learning experience because it's now made us prepared for anything.
If I want to start
Yes,
a
we
company
will.
in the fintech space, can you give me a roadmap for the next 3 years?
Fintech is a regulated space. Ensure that whatever you build follows the letter and spirit of the law. Think 10x in customer experience, but think like 1x on risk management. Fintech is a risk business. And so I would say swing for the fences, but watch your pennies. I think the entire tech landscape of financial services is being turned on its head. I think it's a huge opportunity, and I think if we get it right, that tech can actually power banking in the whole world. Because that's something India's done well.